Good morning. Appreciate everybody coming in pre-snowstorm, and Dr. Plosser is just telling me he's got to get to Newark Airport this afternoon, so hopefully the snow holds off until then. My name is Bob Palmer, and I am a managing director at CMS Mezzanine. We're a subordinated debt fund in Philadelphia that makes loans to companies with $10 million in revenue up to about $100 million. I know we have some reporters in the crowd, so I want to make sure you got all that, and we're open for business, and we're looking to do subordinated loans. My other job is I'm the president of RMA chapter, of Philadelphia chapter of RMA. RMA is the leading association of lending, credit, and risk management professionals. And we are very pleased to have Dr. Plosser with us today to speak to our group. Our industry has really experienced a lot in the past 2 years, and likely will experience some more in the way of consolidation in the future. And RMA has really become an important resource for the bankers, not only in Philadelphia, but nationally, in terms of education, training resources, and almost as importantly, networking. So we talked to the representatives here at the Fed and among the CEOs at the different banks in town. Everyone kind of keeps coming back to the same thing, is we're looking for experienced lenders, we're looking for credit-trained people, and I think RMA provides both of those. Before we get started, I'd just like to introduce Bill Loftus very quickly. Bill is our membership chair, and he'd like to say just a couple words on membership.
Thank you, Bob. Good morning, everybody. Bill Loftus, Wachovia Bank, Wells Fargo Company. I am the membership chair this year, and my spiel is pretty easy. This is the RMA Lending Journal. If you don't get one in the mail every month, you're not a member of RMA. So I would love for all of you to get these. And ironically, there's an article called Balanced Lending, a new credit assessment system that offers a way towards better risk evaluation and a more stable economy, something we're all hoping and praying for. So if you're not getting this, I can help you with that. I have applications. I'll be here after the meeting and would love to have you all join RMA. In addition to the journal, there's access to the website and access to the annual meeting, which is either in Baltimore or DC, a lot of regulators, a lot of great information. So please consider joining us, and thank you very much. Thanks, Bob.
Okay, without further ado, it's my pleasure to introduce Dr. Charles Plosser, President and Chief Executive of the Philadelphia Federal Reserve. He is currently a voting member of the Federal Reserve System's Federal Open Market Committee, which is responsible for conducting our nation's monetary policy. Before joining the Philadelphia Fed in 2006, Dr. Plosser was an economics professor at the University of Rochester's William E. Simon Graduate School of Business Administration, where he also served as dean from 1993 to 2003. During his career, he has been a visiting scholar at the Bank of England and the Federal Reserve Bank of Minneapolis. His research and teaching interests include monetary and fiscal policy, long-term economic growth, and banking and financial markets. He was co-editor of the Journal of Monetary Economics for 20 years and currently acts as co-editor of the Carnegie Rochester Conference Series on Public Policy. He was a member of the New York State Board of Economic Advisors and served on the board of directors of Via Health and RGS Energy Group. He has served on the advisory boards of Rochester New Enterprise Forum, the Chase Manhattan Bank, and the University of Technology Seed Fund. He earned his MBA and PhD degrees from the University of Chicago, and we are very, very pleased to have him speak to our group. Dr. Plosser.
Good morning, everyone, and thank you for that nice introduction. I spent 35 years in the classroom, and it was always in the classroom, everybody filled in from the back to the front. This is just like being in college. Nobody wants to sit in the front row. So thank you, people, for those of you in the front row. You're brave souls. And by the way, there will be no cold calling. Anyway, thanks very much, and welcome to the Federal Reserve Bank of Philadelphia. And thank you for inviting me to help launch your new year. As most of you know, the Philadelphia Fed is one of 12 regional reserve banks around our nation. And together with the Board of Governors in Washington, this structure, reserve banks and a Board of Governors, constitutes the Federal Reserve System, and it helps ensure that monetary policy decisions are based on the full breadth of economic diversity across this country. Now, the goals of monetary policy are in fact set by Congress. And they do that through the Federal Reserve Act, which states that the Fed should conduct monetary policy to, quote, promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. I've long believed, as many central bankers before me, that the most effective way monetary policy can contribute to maximum employment and moderate long-term interest rates is by ensuring that price stability over the longer term. Price stability is also important for promoting financial stability. Now, the Fed seeks to achieve these objectives by influencing the cost and availability of credit through its decisions about interest rates and the supply of money. These decisions are primarily the responsibility of the Federal Open Market Committee, or FOMC, the group within the Fed that's charged with setting monetary policy. Now, since monetary policy affects the economy with a lag, the FOMC must be forward-looking in setting the appropriate policy. Therefore, I'm going to begin my remarks this morning with a review of the nation's economic recovery and my outlook for growth and inflation in the coming year. I'll then make some observations on current monetary policy, including the Fed's current program of large-scale asset purchases. Before continuing, I have to make the usual disclaimer, which says that these are my own views, not necessarily those of the Federal Reserve Board or my colleagues on the FOMC. About a year ago, I was here before another group in this very room, and I said that 2010 would see a moderate but sustainable recovery with real GDP growth around 3 to 3.5%. Now, looking back, growth in 2010 is likely to come in slightly below that forecast, and we'll know more precisely what it is later this month when the data come in. We started out the year with GDP growth growing at 3.75% in the first quarter, but the second quarter fell to less than 2%, as we know. That was due in part to the expected decline in housing sales as the homeowner tax credit was ended. That, plus concerns over European sovereign debt, caused the economy to lose some momentum and led to a worry about a possible double-dip recession. By the third quarter, however, we emerged from the summer doldrums, as I described it, with a growth rate of about 2.6%. When the final estimates are released, I expect that GDP growth will be somewhere in the neighborhood of 2.5% to 3% for 2010. But it will pick up to about 3 to 3.5% in 2011 and 2012. My forecast for 2011 has only changed modestly during the course of this year, and I remain confident that the economy is on track for a continued recovery, albeit a modest one. As with all forecasts, this projection carries some risk, but for now I expect moderate growth overall, with strengths in some sectors outweighing weakness in others. Housing is one sector I believe will remain weak in 2011. We have to remember we entered this recession highly overinvested in residential real estate, and that sector will continue to struggle until inventories decline further. Commercial real estate markets are also still weak. Non-residential construction actually declined in 2010. And I don't see much growth in this industry until we are well into a healthy expansion. It is a lagging indicator, always has been, and will continue to be. That said, I do not believe that the weakness in commercial or residential real estate will prevent a recovery in the broader economy. Business spending on plant and equipment has been a bright spot and appears to be strengthening. While some smaller firms report difficulties in getting access to credit, banks have begun to ease credit standards and make more loans, and their rates are at historic lows. Large firms have been able to finance investment out of retained earnings or issue new debt at very favorable terms. Some investments have been used to replace aging equipment, rebuild inventory, and some have gone to productivity improvements. Productivity improvements are generally very good for the economy over the longer run. Now, the Philadelphia Fed's monthly business outlook survey of regional manufacturers has been consistent with an improving economy, showing significant gains in general activity, orders, and shipments in both November and December, following some weakness during the summer months. The survey's measures of expected future activity indicate that businesses are becoming more optimistic as well. So I expect business spending and businesses to continue to make fixed investments at a healthy pace over the coming year. Consumer spending, which makes up about 70% of GDP in the United States, has expanded at a moderate pace this fall. Holiday spending reports in both stores and online have been positive. November's retail sales were up about 8% from last year, with auto sales up 12%. December retail sales will be out Friday. While the snowstorm in the Northeast and the rain in California likely weighed somewhat on sales at the end of December, major retailers on our surveys remain confident and looking forward to improved spending and have a better attitude than they did early in the summer. Strong consumer spending will occur as households recover more of their net worth that was destroyed due to the falling house prices and the decline in their equity portfolios during the recession. Households have been steadily shoring up their balance sheets, and as debt levels fall and savings are rebuilt, consumers will be in a better position to increase spending, and indeed they're beginning to do so already. The private sector added over 1 million jobs in 2010. They sound like a lot, but unfortunately at that pace, unemployment growth isn't fast enough to bring the unemployment rate down very much. However, recent data have been somewhat more encouraging. New claims for unemployment insurance have been trending downward since September or October. In December, the economy added about 100,000 jobs and payrolls were revised up in both October and November. In addition, the unemployment rate fell to 9.4% in December. I expect the unemployment rate is going to continue to bounce around a little bit in the near term, but I believe the unemployment rate will gradually recover and decline as hiring improves enough to allow the unemployed, as well as those people who left the labor force and will rejoin the labor force over the course of the year. I wish I could forecast faster improvement in unemployment, but it's going to take some time to resolve the difficult adjustments now underway in labor markets. Many workers will be forced to find jobs in new and unfamiliar industries. For instance, contraction in the real estate sector and the sectors closely related to construction, such as mortgage brokerage, means that many workers may likely find jobs in other industries or other fields than they once were in. Productivity gains during the recession occurring in many sectors also suggest that many workers may need to update their skills to find their next job. This is likely to be particularly problematic and challenging for the long-term unemployed. Monetary policy cannot do much to help these types of adjustments in the labor market, even if we wished we could. Let me turn now to inflation. Headline Consumer Price Index has risen about 1% over the past year. Core CPI, excluding food and energy, has been up just a little less than 1% for the past year. Now, while inflation is currently lower than the 1.5% to 2% that many monetary policymakers would prefer, it does not follow that sustained deflation is a risk. While I do expect that inflation will be subdued in the near term, I do not see significant risks of sustained deflation. Respondents to the Philadelphia Fed's fourth quarter survey of professional forecasters, released in November, and the Livingston survey released in December, also saw little chance of deflation. It's useful for everybody to remember that the United States saw an average consumer price inflation rate of about 1.3% throughout most of the 1950s and 1960s. This period of very low inflation did not lead to fears of stagnation, did not lead to fears of deflation. Low inflation per se is not necessarily a bad thing. Moreover, brief periods of lower than desired inflation or even temporary deflation are unlikely to materially impact economic outcomes as long as longer-term inflation expectations remain well anchored and the public continues to see the Fed's commitment and willingness to promise and maintain a stable, low inflation rate and see that commitment as credible. The Fed's challenges, though, are greater, however, when monetary policy finds it difficult to respond because rates are already near zero. In that case, a loss of credibility resulting in a decline in inflation expectations could lead to an increase in the real interest rate, which would encourage consumers and businesses to save more and spend less. That would not be desirable. Given that the Fed's policy rate is now close to zero, a decline in inflation expectations would be unwelcome and would probably undermine the recovery. But fortunately, this is not happening. Expectations of medium to longer term inflation rates have remained relatively stable, partly because people expect the Fed to take appropriate actions to keep inflation low, stable, but positive. As the economy continues, I anticipate that inflation will gradually accelerate over the coming year to about 1.5 or 2%. We are beginning to see accelerations already in many commodity prices. Manufacturers responding to our Business Outlook survey are increasingly reporting rising costs of inputs, including energy, raw materials, and they are projecting that they will be forced to pass on these cost increases to consumers in 2011. As we begin the new year, many forecasters are revising their outlook to incorporate the latest economic data and the anticipated effects of the tax package approved by Congress this December. Although most forecasters assume that some form of a tax package would be approved, the details are now being factored into their forecast. My own view is that the tax compromise's biggest impact derives from the reduction in uncertainty about the tax rates for businesses and consumers over the next couple of years. Unfortunately, despite that, fiscal challenges still loom large for the nation and the new Congress and the economy. Let me now turn to some observations about monetary policy. The last couple of years have been an extraordinary time for policymakers. We've been forced to react with speed to new challenges that have sometimes been outside the usual frameworks that economists often rely on for policymaking. This does not mean that economic models are no longer useful. Indeed, they are. They're quite helpful. But because of the unusual environment we've been in, there's less consensus among economists about the right answers to some of the most difficult challenges that we face. As a result, it's not surprising that debate about what constitutes the most desirable policy is a vigorous one, with bright, talented, and capable people on all sides. That's as it should be, in my view. I'm fond of quoting the American journalist Walter Lippmann, who said, "Where all men think alike, no one thinks very much." Healthy debate is necessary for informed decisions, and they result in better policy choices. As you can imagine and well know, these debates have gone on inside the Fed just as they've gone on in the media and the economics profession. Why would you think it would be any different? Some have suggested, however, that it's counterproductive for policymakers to express differing opinions, as it confuses markets and creates uncertainty. I find such arguments misdirected. First, the reality is uncertainty is real. It would be disingenuous and misleading to suggest otherwise. The central bank owes the public clear communication and as much transparency as possible. For policymakers to project a false sense of certainty would fail that test, in my view, and be deeply troubling. Second, for monetary policy to be successful, policymakers and the Fed as an institution must earn the public's confidence in every way it can. Confidence is important in preserving the Fed's credibility, which is something that's hard to earn but easy to lose. One way to undermine confidence and credibility is to fail to communicate the difficult choices we face and the thoroughness of our debates. Unanimity is not the natural state of affairs in life, nor is it within the halls of the Federal Reserve. For policymakers to feign unanimity only serves to undermine the institution's transparency and credibility. In November, the FOMC decided to purchase an additional $600 billion of longer-term securities through the end of the second quarter of 2011. It's no secret that I've expressed doubts about whether the benefits of this policy, commonly referred to as QE2, exceed the costs. These doubts were based on my own reading of the economic outlook and the nature of the challenges that the economy faced. The first round of large-scale asset purchases began nearly 2 years ago, after the Fed reduced the federal funds rate to near zero. That program, completed in March of 2010, added roughly $1.75 trillion in agency mortgage-backed securities, agency debt, and long-term treasuries to the Fed's balance sheet. If the Fed completes the full amount of the second round of purchases, the Fed's balance sheet will have more than tripled since mid-2008. Proponents of the program to acquire treasuries expect the purchases of these treasuries to lower long-term interest rates through what we've called a portfolio balance effect. That is, as the supply of longer-term securities available to the public is reduced, prices of treasuries should rise, which means yields should fall. Yields on similar assets are also expected to fall, according to this argument, as the public rebalances portfolios away from treasuries into other closely substitutable securities or assets. Just as in conventional monetary policy, lower interest rates would stimulate business and consumer demand, increase exports, and thus leading and supporting a recovery. The Fed's first purchase program did work to lower some interest rates, although the estimates vary quite a lot. But these purchases were done at a time when financial markets were highly disruptive and in some parts of the financial world completely dysfunctional. Asset risk premiums were elevated and some rates were very high as well. But markets are no longer disrupted. They are functioning, and for the most part functioning normally. Thus, it seems unlikely that we can expect the effects of QE2 to operate through the same channels that they operated under the first time. Even if we did, it's not clear to me that a modest reduction in long-term interest rates will do much to speed up the reduction in the unemployment rates. Some commenters have thought that even if the benefits were limited to this policy, the costs were small and the action was worth taking, particularly given the concerns about the state of the economy during the course of the summer. Other commenters argued for the policy because the fiscal authorities were unable to act, even though fiscal policy would have been a more appropriate policy response or tool to address some of these challenges that we face in the labor markets. I view both of these arguments as flawed. It is a serious mistake to view monetary policy as a substitute for fiscal policy. Doctors must diagnose the disease correctly in order to prescribe the right medicine. If they give the patient the wrong drug, the physician might only not cure the patient, they can make the patient more ill. And B, it could be downright dangerous. To suggest that monetary policymakers must act simply because fiscal policymakers are unable or unwilling to act is not the proper way to conduct policy. As to the cost-benefit analysis, the costs of this policy are likely to be seen only sometime in the future. But from my perspective, those future costs must be part of the analysis when the policy is undertaken at the outset, not dismissed to be dealt with sometime later. History tells us that exiting from very accommodating monetary policy has always been a bit tricky. It's always been easier to cut rates than it is to raise them. As I discussed earlier, monetary policy must be forward-looking because it works with a lag. This means that the Fed will need to begin removing policy accommodation before the unemployment rate has returned to an acceptable level in order to avoid overshooting. could result in greater instability rather than greater stability. So how do we exit from this accommodative policy? While the high level of excess reserves in the banking system that sit on the Fed's balance sheet is largely benign now, that will change. As the economy strengthens, banks become more willing to lend, and the demand for loans increases. When that happens, those excess reserves begin to flow out into the economy, and inflation pressures will begin to grow. That's one reason I feel confident that a sustained deflation is simply highly unlikely. To prevent that flow of funds out of the banking system and out of excess reserves into required reserves into lending, the Fed will need to figure out a way to corral those reserves. We must be able to remove or isolate them. The Fed is developing and has been testing tools to help us do that and prevent such a rapid expansion in money in order to address that looming challenge. But we won't know the full effect of how these new tools will work until we begin to use them. Nor will we know how rapidly or how high we may need to raise interest rates to keep those reserves corralled. The larger our balance sheet, the greater our challenges to successfully navigate an exit strategy without disrupting the economy and while keeping inflation under control. The FOMC statements in November and December indicated that we will regularly review the asset purchase program in light of incoming economic information and adjust it as needed to foster our long-term goals of price stability and maximal sustainable employment. I take that intention seriously and will be regularly reviewing that program. If the economy begins to grow more quickly and the sustainability of this recovery continues to gain traction, then the purchase program may need to be reconsidered along with other aspects of our very accommodative policy, not just the purchase program. We are a year and a half into a recovery, although a modest one. And we still have a very accommodative monetary policy. The aggressiveness of our accommodative policy could backfire on us if we don't begin to reverse course at some point. On the other hand, if serious risks of deflation or deflationary expectations emerge, we would need to take different actions so that we adjust our policy accordingly to address those risks, although I think those risks remain small. In conclusion, our nation's economy is now entering from the worst financial and economic crisis since the Great Depression. A slow but sustainable economic recovery is underway, and I expect annual growth for the coming year to be about 3 or 3.5%, even for the next 2 years or so. As the economy continues to gain strength and optimism grows among businesses, hiring will increase. The unemployment rate will decline only to acceptable levels at only a very gradual pace. The shocks and dislocations that we experienced during this crisis were significant and painful, and it will take some time for the imbalances in the labor markets to be resolved. The Federal Reserve remains committed to promoting price stability over the intermediate to longer term. This is the most effective way in which monetary policy can contribute to economic conditions and economic growth and fosters employment and growth. Finding the right path for monetary policy in such a challenging times will require thoughtful and careful deliberations. We should acknowledge the debate is a healthy process that adds to transparency and enhances the credibility of the institution. As we move forward, I will continue to monitor incoming economic developments, update my outlook as necessary. Should evidence suggest that monetary policy is not consistent with our longer-term goals and objectives, then I will support adjustment in our policy stance. Thank you very much. I'll be happy to take some questions.
First of all, I want to applaud you for dissenting at times in the last year or so on the QE2. Can everyone hear me or not? So I just want to say thank you for being a voice or a differing voice within the reserve, and I think I agree with you on the QE2 position that you took. I'm somewhat amazed that there's not more people within the reserve joining your thought process there. And do you think in the next year, in 2011, you're going to see more folks within the reserve agreeing with your position?
You'll have to ask them that. I don't know the answer to that question. I think, I think all of us, whether they have my view or another view, take their role very seriously, and they're very thoughtful about how they come to their conclusions. There are a lot of at the end of the day, there are a number of judgments one has to make. When costs are in the future and perceived benefits are near term, there's an awful temptation on part of not just policymakers but in business to put more emphasis on the short term and discount the long term. I think it's important that we remain balanced in that, but quantifying those longer term costs can be tricky, and people can have different judgments about that. So we'll have to see how policy goes, but most of all, policy is going to be dependent on how the economy evolves more than anything else. And as the economy evolves, our views, both mine and my colleagues' views about what the appropriate path for policy will evolve. And so I think it's not useful to sort of speculate what the outcomes are going to be until we know how the economy is going to evolve. As I said in my remarks, if the economy gains strength, if the traction takes hold and becomes stronger, then from my perspective, it ought to be time to begin reevaluating, removing our foot from the accelerator a little bit and beginning to ease off as the economy takes hold to prepare for a return to kind of normal monetary policy. On the other hand, if the economy further deteriorates, if inflation expectations fall or inflation falls further, then that might be a call to think about other actions we could take to stem those challenges. So it's just going to be a question of how things evolve. We all base our actions in part on our forecasts, right. And forecasts can be wrong, but as I said at the outset, because monetary policy acts with a fairly long lag, we can't help but rely somewhat on our forecasts and then adjust policy as the data come in.
Right. Good luck with it.
Thank you.
Mr. Plosser, could you comment on the impact that Dodd-Frank may have on the recovery in general and small business lending in particular? Mind saying a few words on that?
This $64 trillion question, right? I don't know the answer to that. I do think that it's too early to tell. There are hundreds of rule-making bodies around, rules to be written to implement Dodd-Frank. We are still at the very beginning of that process. I think many of the aspects of Dodd-Frank, in particular the details, will depend on how the rules actually get written as much as anything. And agencies, whether it be the FDIC, the OTS, I mean not the OTS, OCC, the Fed, are busy, deeply immersed in trying to figure out how to write the rules to implement the intent of Congress and to implement the bill. There's undoubtedly will be give and take and debate about how those rules get written, with people having different points of view. Until that plays itself out, it's really hard to get much of a handle on what's going to happen. The new Consumer Protection, Financial Consumer Protection Board is another area where there's just remain a lot of unknowns about how this will affect. It is a lot more regulation. It will be more burdensome, without a doubt, to lots of institutions in various ways. But right now, I don't have a good handle to tell you what the quantitative magnitude of the effect's going to be. Part of me sort of says that can be costly to the financial system and to our economy by imposing those rules and regulations if they go overboard. On the other hand, American businesses are remarkably agile and adaptive. And another side of me says we'll adapt and firms will figure out how to do business and do business as best they can under the new framework. And therefore, it's just hard to know exactly how the burden plays out versus the adaptability of firms and businesses to sort of grow and prosper. So I wish I could be more specific, but I think just a lot remains to be seen, and there's a lot of work going on. I've described this as the Full Employment Act for regulators, is what this is.
Do you have any sense of the timeline for this?
Well, it varies. I mean, there are lots of different things going on. Obviously, Basel is going on, and in the international circles is still being debated, and there are lots of discussions going on there. There are lots of rulemaking going on inside the Fed. Dodd-Frank does, for some types of sections of the legislation, requires specific dates for those rules to be implemented. Many of them fall at the first year anniversary. Some of them occur a little earlier. There are some options for extending the time if the agencies haven't completed the rule writing process. But those who are involved in that rule writing process find the deadlines very, very pressing and demanding on their time and their energies and what we need to get done to meet those deadlines.
How does the national debt or how does the federal deficit and the national debt, I know the Fed maybe cannot directly influence it, but what are your views on the level of national debt we have out right now, and what, if anything, can the Fed do other than, kind of using the bully pulpit to try to work through that?
Mostly we have to use the bully pulpit. Fiscal policy is not our responsibility. I think the chairman gave testimony just last week and made it very clear, I thought, that we have a fiscal problem in this country. We are operating under some projections that we know are not sustainable. And that Congress, as I alluded to in my remarks, Congress faces, and the public faces some severe challenges about how we put fiscal policy back on a more sustainable path. I'm less concerned about the level of the debt. I'm concerned because it's growing. And if you look at CBO projections and other analysts who put out projections of the national debt, it keeps on growing. So the first thing that I think Congress needs to do is figure out how to commit to a fiscal package over some intermediate term that will actually stabilize the debt to GDP ratio at some level. Economists don't really know what the right level is. I mean, there are countries around the world. Japan has well over 150% debt to GDP ratio. We're still only at about 60 or 70. Other countries have much larger debt burdens, sovereign debt burdens, and not all of them are financially insolvent. So we don't really know what the right level of debt is, but from my perspective, it's very important that it stop growing, that we stabilize it at some level. And that doesn't mean that deficits go away. It just means that we have to be able to run deficits at a pace that kind of keeps pace with the economy. And in that case, the debt to GDP ratio would stabilize. And I think that's the first step that Congress needs to tackle. And it's not about what the deficit is today. It's putting together a plan, and most importantly, a credible plan that will make such a outcome much more likely. So it's a big challenge. It's not going to be easy. It's not going to be easy. The real challenges, of course, are in issues of health care, entitlement programs, all of which are the ones that are growing and making the problem. And those are the things that we need to tackle. And, of course, we all know that politically those are the things that have been most difficult to deal with.
Doctor, why do you think long rates jumped so much recently, especially in light of quantitative easing?
Yeah. Well, both nominal and real long rates seem to have risen. Rates move all the time. They move every day, sometimes a lot, sometimes a little. Some people have said, well, that was proof that quantitative easing didn't work. I'm not prepared to say that. I think that one of the reasons rates have gone up, particularly real rates, I believe is the outlook for the economy has improved. That the data have come in over the course of the last 2 months that show that the economy is doing a lot better than a lot of people thought back in September. Things have turned around in kind of a very positive way compared to what a lot of people were thinking. And I think that's one reason for long rates to rise, a natural reason for long rates to rise. But we've had a lot of volatility over the course of the fall that I think it's very difficult at this point to disentangle what's been going on, particularly in real rates or in treasury markets. We had the sovereign debt crisis and a flare-up again with Ireland. What happened there, you could fully expect a flight to quality. When you had a flight to quality, that's going to drive, right? So prices down and yields up. We saw that the last time there was a crisis a scare in the European markets. So you had a whole bunch of different combinations of things that were going on this fall, ranging from bad economic news, sovereign debt crisis reemerging, challenges reemerging in Europe, and a strengthening economy in the United States. So how all those things played out in explaining the movement in yields between September and the end of the year, I don't think it's hard to really assign, we had an election, we had a tax package passed, so I think disentangling the movements in yields over the course of the last 3 or 4 months, I'm very hesitant to attach, consequent, what did what, who did what to whom, so to speak. It's really too complicated. And more than that, it's certainly too early to tell and make a good analysis of that. I suspect there'll be young PhD students and economists looking at the data and trying to parse the movements into these different effects, but that's going to take some time. So the positive way to spin it is the economy looks better and real yields go up. I'll settle for that if that turns out to be the right story.
Dr. Plosser, could you give me your opinion on how information technology has changed the flow of information in terms of economic forecasts that were generated from history during the Depression in the 50s, and how it shapes your opinion going forward when you make your personal forecasts?
Well, certainly economics has become a lot more quantitative and a lot more of a science since the 1950s. We have a lot more both econometric models and theoretical models to work with. We have people both as well as the board generating forecasts based on models and using judgment as well. So it's a very important way for policymakers, or an input into policymakers' thinking. Because one of the things that becomes much more difficult is that quantifying the effects of various types of policies become very hard. And you have to have something to go on. You have to sort of have either some past experience or history or some model that's telling you how to think about certain types of effects and how they're going to work in the economy. That is what economists in the Federal Reserve System spend a lot of their time working on in their research. But at the same time, policymakers, my colleagues around the table, even though many of us are PhDs, I spent years teaching PhD students how to do econometrics and build models and estimate models and forecast. Even though we understand all that, we also understand its limitations. We also understand that there are large degrees of uncertainty about some of these things, and that when we sort of count on effects, sometimes those effects have lots of potential error associated with them. There's a great lesson that statistics teaches, is that when you're uncertain about an action, don't overreact. Because if you're wrong, the cost could be high. I think the chairman used the putting analogy, I believe, in his testimony recently. So you have a putt, but you don't know exactly what it's going to do. So what do? You tap. You don't ram it into the back of the cup. Because if you're wrong and you overshoot, you might have even a bigger problem as the putt comes back. So I think that's a useful analogy to think about policy being somewhat more cautious because there's the realization that in fact there are those kinds of uncertainties that are real and they matter. And if you get it wrong and the effect is not what you thought it was, it could be very different and actually make you worse off rather than better. It's an analogy to medicine, which is has a lot of science in it, but there's a lot of trial and error too. And if you misdiagnose the disease and give the wrong medicine, you could kill the patient. So at some points, caution and patience can be a virtue here.
Europe seems to be in and out of news that come through the European Union. And recently the announcement by China and Japan over the evening hours, is that
Over what?
with them buying their securities, is that a prelude of more of those actions coming across continent? And what's your view of where Europe stands? Because that seems to be the most, at least relative to the U.S. markets, there seems to be more and more news coming that may not be expected by the markets.
Well, I think we know Europe has a challenge in front of it, dealing with the sovereign debt crisis, dealing with the loan guarantees, dealing with the threats in different countries, dealing with fiscal policy and differences across nations within the EU. So they've got their work cut out for them. And there are risks there for the United States. I don't believe they're substantial at this point. I think they can be mostly remain within Europe. That doesn't mean that we would have no effect, but I think that U.S. financial institutions, by and large, are much less exposed to some of those issues. I think the challenge we faced last spring, when the Greece issue finally sort of became problem number one in Europe, the U.S. was just beginning to get its feet back on the ground. The fragility of the financial system was being stabilized. And I think that what happened in Greece and Europe in the spring, sort of shook the foundations a little bit because people didn't know what to expect, didn't know how it was going to be handled, didn't know what the consequences might be. I think that was part of the source of what led to sort of the kind of freezing up and slowdown that we experienced in about the 3 or 4 months that followed that. Now I think that there's probably a little more confidence and a little more stability to the financial industry and financial institutions here in the United States. We have a better picture as to how Europe will be trying to deal with this as it comes. So it's going to be a little less of a surprise. So I'm hopeful that while there's risks there, clearly, that we're a little better shape to deal with them as time goes on. Hopefully the challenges will fade. But they've got their work cut out for them. All right, well, let me thank you all again for inviting me. I was delighted to be here. I didn't have to come far. And let me wish you all a very, very happy and prosperous new year. Thank you.
Thank you, and on behalf of the RMA Philadelphia Board of Directors, we want to thank Dr. Plosser for his time, expertise, and for being with us this morning. One of the fundamental benefits that RMA offers are our educational programs. My name's Elizabeth Riney. I'm with PNC Bank. I'm the RMA Philadelphia Educational Chair. Wanted to give you a little bit of information about our upcoming programs, educational and networking opportunities. If I could point your attention to the papers that were listed on your chairs. The upcoming educational programs that we have to offer are on January 24th, Global Cash Flow, February 25th, Understanding and Interpreting Real Estate Appraisals, March 7th through 8th, Financial Statement Analysis. We also have an event, an inaugural event, and a Young Bankers event, Wine and Chocolate, at Naked Chocolate in Center City on January 27th. All young bankers are welcome. If your institution would like to offer any programs that may not be listed here or on our website, please reach out to us and we would be happy to work with you and create programs from our catalog tailored to your institution on what you may be looking for. So please be sure to reach out to us if that's the case. And as a final remark, if you are staying for the Chief Credit Officer Roundtable, please gather outside the room by the coat closet. Thank you very much for coming this morning. Please be safe in the snow this afternoon, and Happy New Year.